Welcome to the Deep Dive. If you've been trying to make sense of the market lately, you know it feels less like a clear path and more like a swirling vortex of conflicting signals.
Yeah, it's definitely confusing out there.
One day we're talking about cooling inflation, the next, uh, a major geopolitical fuse is lit. It's enough to make your head spin, isn't it?
Absolutely.
Our mission today is to cut through that noise, sift through the latest analysis, and bring you some real clarity. We're diving deep into navigating the U.S. stock market amidst escalating geopolitical risk and the Federal Reserve's newly defined stagflationary pause as of, June 19, 2025.
That's right. Our goal with this deep dive is really to pull out the most important nuggets of knowledge from all the analysis out there. We want to clarify those opposing viewpoints you're seeing and hopefully present a clear point of view with some actionable strategies.
So you, the listener, can walk away feeling truly well-informed.
Exactly. And maybe even have one of those powerful aha moments that, shifts your perspective a bit.
Okay, let's unpack this, starting with the big picture, the macro landscape shift. And specifically, this thing we're calling the stagflationary pause. For months, the market seemed to operate with this strong prior belief, right?
Yeah, the narrative was pretty set.
This expectation that cooling inflation data, like that May's CPI print we saw, was going to pave the way for a dovish Fed pivot. But has that belief really held up?
It's been fundamentally challenged, absolutely. That June 18 FOMC meeting was the defining moment. The Fed, as expected, held rates steady, 4.25 to 4.50%. No big surprise there.
Right.
But the critical shift, the real news, came in their updated forecast for 2025. They now project higher inflation-moving PCE, that's the Personal Consumption Expenditures Price Index.
That's Fed's preferred gauge.
Exactly. They moved it up to 3.0% from 2.7, and at the same time, they're forecasting lower GDP growth, down to 1.4% from 1.7.
Lower growth, higher inflation.
And what's really striking is that Fed Chair Jerome Powell explicitly linked this more hawkish stance to the uncertain impact of, trade tariffs.
So wait, on one hand, we had May CPI data showing a cool down, which seemed positive, right? But then the Fed comes out with this new hawkish forecast. How do those two pieces, which seem to contradict each other, actually fit together in the market's mind?
That's a really important question. That May CPI data, the 2.4% year-over-year number, it's now largely considered, priced in.
Old news, basically.
Pretty much. The market has fully digested that backward-looking data point. Its focus has decisively shifted. It's less about what was and more about the Fed's forward-looking guidance and how they might react to future stuff.
Like the tariffs.
Exactly. The market's basically saying, okay, we saw a cool CPI, but the Fed's telling us the future looks different because of tariffs, and we're listening to the Fed.
And if that wasn't enough complexity, right?
Yeah.
Then we had a significant compounding factor layered on top. A major geopolitical flare-up.
Yeah, things got tense.
Tensions have truly escalated between Israel and Iran. We saw Israel threatening Iran's supreme leader after an Iranian missile strike hit a hospital in southern Israel.
A serious escalation.
And then, to add another layer of uncertainty, the Trump administration decided to delay U.S. military involvement for 2 weeks, ostensibly to create space for peace talks.
But for the market, it just means more uncertainty.
Right. It injected this period of high uncertainty, creating what we call an unpriced risk premium, especially noticeable in, say, energy and defense sectors.
Exactly. This combination, the Fed's updated outlook and this geopolitical tension, leads to a really crucial insight.
So what does this all mean for us? The core insight here, it seems, is that this isn't just a standard hawkish pause from the Fed.
No, it's different.
Fundamentally a stagflationary pause. You've got slowing economic growth, that 1.4% GDP forecast, combined with persistent externally driven inflation, especially from those tariffs pushing PCE up to 3.0%.
Stagflationary, that's the word.
And for you, the investor, this isn't just jargon, it's a critical shift. It means the usual playbook for, growth investing might be turned upside down, demands a completely different approach. So what does this shift mean for the actual investment landscape? Where's the money going?
Well, this dynamic fundamentally alters the investment landscape. We're seeing capital rotation away from high interest rate sensitive sectors.
Like tech.
Yeah, think long duration growth tech.
Yeah.
Those companies whose big profits are way out in the future, so they get hit hard by higher rates. And consumer discretionary, too, which struggles when consumers tighten their belts. Conversely, capital is rotating towards real assets, commodities like energy and materials and sectors with Inelastic demand or strong pricing power.
Things people need regardless.
Exactly. Healthcare, defense, and maybe cybersecurity fit in there.
Okay, given all this uncertainty, these shifts, what are the immediate market scenarios we should be thinking about, say, for the next 24 hours?
Right, the very near term. Our analysis suggests three main possibilities. First, and with about a 50% probability, we have cautious consolidation. That's kind of the baseline. The market just keeps digesting the Fed news, the geopolitics, leading to choppy, range-bound trading.
Makes sense. Scenario 2.
Second, there's maybe a 35% probability of geopolitical de-escalation or maybe some dovish Fed speak. If we get some good news on either front, you could see a risk-on relief rally.
A bit of optimism returning.
A bit. And finally, there's a smaller 15% probability of risk-off escalation. If things worsen geopolitically or there's other bad news, you could see a sharp sell-off, a flight to safety.
So consolidation is most likely, but with decent chances for moves either way.
Exactly. From a sector outlook perspective, the S&P 500 is likely to stay in that consolidative pattern, maybe trading between, say, 5,800 support and 6,000 resistance, roughly.
And the Nasdaq, you mentioned tech being sensitive.
Yeah, the Nasdaq, being home to those high-duration growth stocks we talked about, looks the most vulnerable to this stagflationary narrative. The Dow Jones, though, might show some relative strength. It has more value-oriented companies.
Okay. What about leading sectors? Where's the strength?
Leading sectors right now, energy, materials, and defense cyber. Think ETFs like BOG for cybersecurity or ITA for aerospace and defense. They're outperforming.
Why them specifically?
Well, it's the geopolitical conflict boosting defense, rising commodity prices, helping energy and materials, increased defense spending, and they're often seen as inflation hedges.
Got it. And lagging.
Lagging sectors include big tech, the FAANGs and similar names, housing, and broad retail. They're getting hit by high borrowing costs, those tariffs we mentioned, and weakening consumer confidence.
And defensive plays.
Utilities like XLU and healthcare XLV are kind of neutral to defensive havens. Stable yields, inelastic demand, places to hide out, maybe.
Okay, that paints a clearer macro picture. Now let's shift gears. High conviction stock selection. In this environment, just following headlines isn't enough, right? You need to go deeper.
Absolutely.
Using what we call first principles and chain of thought to connect these core market drivers to specific companies. Find the real opportunities. Can you walk us through how that works with some examples?
Yeah, definitely. It's about boiling down a company's potential to its fundamental drivers, its core reason for being interesting right now. Let's start with Nvidia, NVDA. Its first principle, the core idea, is that the AI paradigm shift creates just insatiable demand for high-performance computing hardware.
Everyone needs their chips.
Everyone needs their GPUs. And the rationale is clear. NVIDIA's dominant market position, like 80% of the GPU market, estimates say, fortified by its proprietary CUDA software, creates this deep competitive moat. Plus, you have major tech companies, Meta, Amazon, Google, committing over $200 billion collectively to AI infrastructure in 2025 alone. That demand is real, makes NVDA test all-time highs.
That makes sense. Very clear driver. Okay, what about Tesla, TSLA? What's the first principle there? It feels different.
It is different. For Tesla, the first principle we're looking at is that the ultimate value of a transportation network gets unlocked through autonomy and asset utilization, not just selling cars.
Oh, the robo-taxi idea.
Exactly. The rationale is their strategic pivot, moving from just being a vehicle manufacturer to becoming a high-margin software and services company centered on full self-driving, FSD. That imminent robotaxi service launch in Austin is the critical, tangible test of this whole ambitious thesis.
And the market's buying into it.
Well, the stock rallied 60% from its April lows based pretty much on this narrative alone. It's a very binary bet on the success of that launch, you know?
High stakes. Okay, next up, CoreWeave, CRWV. What's the core principle driving this one? Less household name, maybe.
Right. Here, the first principle is classic. In the AI gold rush, the most profitable businesses often sell the picks and shovels, meaning access to scarce GPU computing power. CoreWeave is a specialized cloud provider doing just that, offering access to these critical scarce resources, especially NVIDIA GPUs, to AI labs like OpenAI. This has fueled just exponential revenue growth, up 420% year over year in Q1. And they have a staggering $25.9 billion contract backlog. So it's been an extreme momentum play since its IPO back in March 2025. And it looks potentially ripe for a short squeeze.
Interesting. Okay, moving to Vigil Neuroscience, VIGL. This seems like a completely different category again. What's the first principle here?
Vigil highlights a different principle. In an M&A mergers and acquisitions scenario, a target company's valuation often decouples from its day-to-day fundamentals. Instead, it becomes governed mostly by the probability of the deal happening.
So it's about the deal itself.
Exactly. The rationale is that Sanofi has a definitive agreement to acquire Vigil. The price is $8 cash plus a $2 contingent value, right? A CVR.
What's a CVR?
It's basically an extra payment tied to a future event. In this case, it's linked to the success of an Alzheimer's drug Vigil is developing. So, VIGL's stock price is trading as a function of how likely the market thinks that deal is to close, not really its biotech prospects day to day.
An arbitrage play almost.
Kind of, yeah. Depends on your view of the deal closing.
And finally, a more speculative one. K-West Microsystems, KWE. Microcap, you said. What's the first principle that makes this interesting?
Yeah, KWE. The first principle for microcaps, especially those with low public floats, meaning not many shares readily available to trade, is their susceptibility to just parabolic moves on specific game-changing news catalysts.
Big news can move them a lot.
A huge amount. K-West is a small defense tech company, market cap under $100 million before its recent surge. On June 18th, they announced a prototype order for their Battlefield Laser Detection System, BLDS, from a major North American defense contractor. That single announcement triggered a massive price and volume spike. The stock was up, 145.55% that day? It's a prime example of how a small float plus big news can lead to explosive moves.
Okay, so those are the individual stories. But this is where understanding conflicting signals becomes really crucial, right?
Absolutely. Nothing's ever simple.
In a world full of data, much of it contradictory, making complex decisions can be really tough. This is where frameworks like Bayesian thinking or tree of thoughts can help. They help us resolve these contradictions, leading to clearer insights for you, our listener.
Weighing the evidence.
Let's dive into some of the conflicts in these stocks we just discussed. The aha moments often come from resolving these tensions.
Let's absolutely do that. It's key to making informed choices. Let's take Nvidia, NVDA first. The conflict here is pretty clear. You have exceptionally bullish technicals, momentum, and this powerful AI-driven sentiment versus some bearish signals, like reports of heavy insider selling and its general vulnerability to macro risk-off events. If the whole market sells off, NVDA likely goes down too.
Right, so bull story versus macro risk and maybe insiders knowing something.
Kind of. The resolution, as we see it, the AI demand story is a structural, multi-year trend. That's the core bullish case, and it's strong. The macro risk is more of an acute event-driven variable. It could hit, but it's not the fundamental story. So in the absence of a new major risk-off shock within, say, the next 24 hours, the primary AI demand trend probably holds. We're giving the bullish path maybe 7% confidence here.
Okay, 70% bullish bias, barring a shock.
Right.
What about Tesla? TSLA, what's the conflict there?
With Tesla, the conflict is that bullish hype surrounding the imminent robotaxi launch. That's battling some pretty bearish technical indicators, like RSI divergence, where the price goes up, but momentum weakens.
Let's have strength down.
Yeah, and also weak underlying fundamentals, like reports of declining vehicle sales in some areas. So hype versus reality, almost.
How do we resolve that tension?
The resolution here is realizing the stock's price action right now is almost entirely dictated by catalyst anticipation. It's all about the robotaxi launch. So until that catalyst fails to materialize, or if it launches and proves disappointing, the existing upward momentum likely has the edge. We see about 60% confidence for the bullish path on this one, but it's clearly a high-stakes bet on that single event. Very binary.
Got it. A bet on the catalyst.
No.
Now, CoreWeave. CRWV. You mentioned the incredible growth, but also risks. What's the core conflicts?
Oh, the conflict in CoreWeave is stark. You have this incredible bullish growth story, that 420% revenue growth, the $25.9 billion backlog, versus an extremely risky financial profile.
How risky?
We're talking massive cash burn reported, $1.35 billion burned in Q1, and a substantial debt load. So huge growth, huge burn. How do you square those two very different realities?
Yeah, that's a tough one. What's the resolution?
This is fascinating. When you dig into the quantitative data, the most powerful short-term force here seems to be the short squeeze potential. CoreWeave has an 8.64% short float. That's significant. Over 8% of its publicly traded shares are sold short. And the borrow rates, what it costs shorts to borrow shares, are punitive, reportedly as high as 210% annualized sometimes.
Wow, that's incredibly expensive to bet against it.
Exactly. This combination creates a technically explosive situation. It means short sellers are trapped, facing huge costs. This makes a potential short squeeze the most likely immediate driver of the stock price. We have maybe 75% confidence in its short-term squeeze potential. It's like a tightly wound spring. If the price starts moving up, shorts are forced to buy back shares to cover their position, pushing the price even higher.
So the technicals are overriding the fundamentals, at least short term.
In this specific case, it looks like the most powerful force, yes.
Okay, so we've dissected the stocks, the conflicts. How do these detailed insights translate into an actionable plan? Broader strategic thinking for you, our listener, trying to navigate this.
Right, let's get practical. Let's look at some key elements from the action plan summary, focusing on triggers and targets. Remember, these are just examples based on the analysis, not investment advice. For Nvidia, NVDA, a potential bullish scenario trigger could be a break and hold above $147 on, say, a 1-hour chart, with a possible price target around $153 and maybe a stop-loss zone near $145 to manage risk.
Okay, clear levels. What about Tesla? But maybe the bearish side.
For Tesla, TSLA, a bearish scenario trigger might be if the price breaks below its rising trend channel support, which looks to be around $314 currently. That could target a move down to maybe $295, with a potential stop loss placed above the channel, say around $324.
And CoreWeave, the squeeze play.
For CoreWeave, CRWV, that bullish squeeze scenario trigger could be a break and hold above its recent all-time high of $176.75. The target could be $200 or even higher for real squeeze ticks hold. A stop-loss zone might be around $165.
And the microcap, K-West.
K-West Microsystems, KWE. The bullish trigger there could simply be the price holding above the previous day's high, which was $11.21, with the potential target of $15 and maybe a stop-loss zone around $10.50. Again, very volatile name.
Now, for the strategic chess players out there, this next bit is really interesting, I think. Let's discuss second-order effects and intermarket correlations.
Yeah, this is about thinking beyond the obvious connections.
We've talked a lot about the geopolitical risk. How can you strategically hedge against that or maybe even position to profit from it?
Okay, consider this. The geopolitical hedge. We noted that a long position in a defense stock like K-West Microsystems, or maybe the energy sector ETF XLE, is likely positively correlated with escalating geopolitical risk.
Meaning, if risk goes up, those stocks tend to go up.
Generally, yes. An escalation would likely cause oil prices and defense stocks to rally. Now think about the next step. That rally, especially in oil, could force the Fed to remain more hawkish, or even get more hawkish.
Because of inflation fears.
Exactly. And a more hawkish Fed disproportionately hurts those rate-sensitive growth stocks, the ones often found in the Nasdaq 100, the QQQ ETF.
Ah, I see where this is going.
So a sophisticated strategic pairs trade to consider might be long KWE, short QQQ, or long XLE, short QQQ. This structure aims to profit potentially from the very event geopolitical escalation that threatens the broader market, especially growth stocks. It offers a unique form of strategic protection or even alpha generation.
That's a truly clever way to think about managing risk while potentially finding opportunity in the chaos. Very insightful. And what about the ripple effect from a major AI player like Nvidia? How does, say, good news for NVDA extend beyond just NVDA itself?
Right, the AI infrastructure ripple effect. Think about it like dominoes. A major positive catalyst for Nvidia may be much better than expected earnings, or a new breakthrough creates a clear chain reaction. The first order effect is obvious. NVDA itself rallies.
Okay.
The second order effect is often a sympathy rally in the broader semiconductor sector ETF, SOXX. The whole industry gets a lift because the leader is doing well.
Makes sense. And third order.
The third order effect can be a surge of speculative capital into higher beta, more volatile AI plays like
CoreWeave.
Exactly, like CoreWeave. These stocks might benefit disproportionately as excitement builds in the AI space. So the strategic implication here is that a confirmed positive NVDA catalyst could actually be used as a leading indicator to initiate a long position in CRWV, aiming to capitalize on its higher volatility and that potent short squeeze dynamic we discussed.
So you watch the lead domino, NVDA, and anticipate the next ones, like SOXX and maybe CRWV.
Precisely. It's about understanding those interconnections.
Okay, pulling all this together then, based on the analysis, the conflicts, the strategies, how would you rank these specific trade setups we've discussed for you, our listener, trying to prioritize?
All right, let's try a ranking, keeping in mind risk profiles. Rank 1, CRWV, long. We see this as having the highest potential risk-reward, mainly due to that short squeeze possibility, combined with immense growth and a clear technical breakout potential. This is definitely an aggressive profile, though. High risk.
Okay, highest risk-reward, rank 2.
Rank 2, KWE long. We see this as perhaps the best strategic hedge play. It's driven by fresh, high-impact news and offers potentially asymmetric upside against that geopolitical risk factor. Also aggressive, very catalyst-driven.
Rank 3.
Rank 3, NVDA, long. This represents the core bullish AI theme. It has arguably the strongest fundamental AI story, but maybe a lower risk-reward right now simply because it's trading near all-time highs. Suitable for a balanced to aggressive portfolio, maybe.
Okay, rank 4.
Rank 4, VIGL, long. This is really about capital preservation or arbitrage. It's the lowest risk on this list because of the cash buyout offer from Sanofi, but that also means its upside is capped. Definitely a conservative play.
And finally, rank 5.
Rank 5, TSLA, long. We see this as essentially a binary event bet on the robotaxi launch. It feels like the least attractive right now without a confirmed positive catalyst, and it carries significant binary risk, big win or big loss potential on that news. Our analysis suggests maybe avoiding it until there's more confirmation.
That's a really helpful hierarchy. Thank you. Now, one last crucial point. To truly stay ahead, we have to talk about echo chamber prevention logic.
Avoiding confirmation bias.
Exactly. This helps you avoid just hearing what you want to hear and helps identify assumptions that might be outdated now. So what signals that we, or the market, once held true, are now obsolete? Or maybe which ones have been reactivated?
Great point. A key signal that is now, I would say, discarded is the notion that the market expects a dovish Fed pivot.
That's dead.
Pretty much. That assumption was decisively invalidated by the June 18 FOMC meeting. The Fed clearly signaled a hawkish pause, prioritizing future inflation concerns, especially from tariffs. The new baseline is a Fed on hold, but biased towards worrying about those tariff risks. Dovish pivot is off the table for now.
Okay, so if the dovish pivot idea is gone, what about that cooling CPI data we saw back in May? Is that also obsolete now?
Indeed. The idea that May CPI data shows cooling inflation is now largely priced in and pretty much obsolete for near-term market direction. While that 2.4% year-over-year CPI was, benign, the market is forward-looking. The Fed's decision to project higher future inflation despite that data point has rendered the May report largely irrelevant for what happens next. The market digested it and moved on.
Okay, old news. So what themes are back? What's been reactivated that we really need to pay attention to now?
The big one is tariff uncertainty. This theme has been dramatically reactivated. It was kind of a background concern for a while, maybe simmering. But the Federal Reserve, by explicitly citing tariffs as the primary reason for its updated stagflationary forecast, has elevated this theme. It's moved from being just a chronic, low-level risk to arguably the central driver of U.S. monetary policy right now and the market's primary macro headwind. That's a huge shift in focus.
So tariffs are front and center again, directly influencing the Fed.
Directly cited by the Fed. That's the key change.
And there you have it. Wow. We've covered a lot of ground. We've navigated the shifting macro landscape, from the Fed's new stagflationary pause to the escalating geopolitical tensions. We've dissected specific stock opportunities, looking at the drivers, the conflicts, provided actionable strategies, potential triggers, targets, and even explored some sophisticated hedging insights.
Yeah, hopefully connecting the dots.
Our goal with this deep dive really was to provide you with a clearer point of view and actionable strategies for navigating today's complex investing environment.
We really hope these insights empower you to make more informed decisions, helping you see beyond just the headlines, beyond the typical news cycle, and really understand the deeper forces at play.
And maybe give you that aha moment we talked about.
Hopefully.
To leave you with a final provocative thought for you to consider. Given this intricate web we've discussed, geopolitics, central banks, technology shifts what other previously stable assumptions in your own areas of interest, maybe outside of finance even, might now be on the verge of invalidation.
Interesting question.
How can you proactively identify those potential shifts and adapt your own understanding before everyone else catches on? To ensure you stay ahead in understanding crucial market shifts and strategic insights like the ones we discussed today, make sure to subscribe to the Deep Dive for the fastest and most frequent updates.
Stay informed.
You won't want to miss our next dive into the market's biggest movers and the forces driving them.